Good afternoon, everybody. I'm Lloyd Bell. Thanks for coming. I tried very hard to not be with you today. I failed spectacularly, but I did get my good friend and colleague Mark Kazanek to share the time with me. What we're going to talk about today is several things. And, we always say we'd like it to be conversational, so please ask questions. Nobody asks questions during the presentation, so I'll say it anyway. Please ask questions. Certainly at the end, we'll answer any questions you may have. But we're going to talk about several things. First, we're going to talk a bit about deal flow. And then we will do a quick foray into financing. Are there any commercial lenders in the room? We have one? Okay. You can do that section. And then we are going to talk about due diligence. And if we have some time at the end, I will go through sort of the current purchase price multiples. Everybody gets excited about that stuff. To me, it's like watching the weather at the end of the news. What's it going to be? What's it going to be? So let's talk about deal flow. Did I advance that slide or that happened by itself? What's driving deal flow? You've heard the phrase silver tsunami several times today. It kind of rankles me a bit, but there are aging baby boomer business owners. Say that 3 times fast. Aging baby boomer business owners. There are approximately 33 million companies in the United States. 30 million of those companies have 4 or fewer employees. I'm guessing none of those are attractive to the ETA buyers in the room. So that leaves us with about 3 million companies out there. Approximately 40% of all businesses are owned by baby boomers. So I'm going to take some liberties and say that about 1.25 million companies are owned by baby boomer businesses. Again, try saying that. So 1.25 million companies out there. I don't know what you're doing in this room. You should be out there meeting with them. Secondly, private equity capital. There's been an enormous amount of private equity raised over the last really 20 years. Right now, it's estimated there's about $1.1 trillion of dry powder in the United States from private equity funds. And they have continued to move lower and lower downstream into the middle market, and we're seeing them compete for the types of companies that you may be looking at. You also have existing businesses that are looking for strategic acquisitions, add on to their business. It could be into new markets, new geographies, new products or services. So these are the folks that you're also competing with when you're looking at businesses. And there are always challenges when it comes to your deal flow. The valuation gap being a significant one. Buyers and sellers have different sort of attitudes towards the business. And right now, I think what we're seeing is we had a pretty good run of performance starting in 2021, 2022 for a lot of lower middle market businesses. Really kind of the rebound from COVID, and we saw strong performance in 22, 23. Every year I'm waiting for that drop-off to occur. Hasn't really occurred yet. 24 was good. 25, we start to see a little bit of softening. And I think from the buyer's perspective, there's always a little bit of skepticism about, am I buying at the peak? How do I price this company if I don't know if that trend is going to continue? Meanwhile, you have the sellers, who, not surprisingly, will tell you that things are going great and it's only going to get better. Financing is always a little bit tricky. For our one lender in the room, give them a hug. It's been a challenging business these last several years. Sort of post-pandemic, the government has been an awful competitor for the banks because they don't want to be repaid. But now we're seeing an environment where I think there's some enthusiasm for lowered interest rates. In fact, the Fed lowered them again today by another 25 basis points. So that might loosen up some more activity. Then you've got greater macroeconomic risks, certainly right now tariffs being one of the main ones, but we've been facing supply chain issues for the last 4 years as well that that may or may not be settled anytime soon. So there's a lot of risk that buyers see when they're looking at companies. You want to chat about?
Keep going.
Well, no, I thought you want to talk about this. So I didn't read the slide, so I'm going to read it along with you. So more challenges. We have up here 20 to 30% of small businesses successfully transition. I think it's probably a good number. A large number of businesses are not saleable. And we see that sometimes in think about an old manufacturing setting and maybe a machine shop, a job shop that doesn't have proprietary products. they don't have a high demand as an ongoing business. And so not every company is going to be sold. And it's a hard message to give to some of our clients that are at the end of their career and they want to sell their business. They meet with us and they say they want to sell. I'm like, I hope you saved a lot along the way, because it's not everything's going to go. And the other point that's, I think, very relevant that's on here, that just because you have received or have written a letter of intent, by no means does that mean the deal is going to close. You heard Carla Macklin this morning talk about the fact she had 4 LOIs fall apart on her in her current quest for a business. So it really is not uncommon that once you get to an LOI, the deal is nowhere near closed. In fact, that's probably the lowest hurdle towards getting the deal closed, is getting a signed LOI. But I cover everything on the slide you wanted to cover?
You did a better job than I
mean, again, I didn't read it until just now. So let's talk a bit about, it's still me. I'm telling you, I tried to pawn it off on you, and now you want it, huh? Talk about lending conditions. The current lending conditions are getting a little bit easier. The Phoenix survey of lenders that came out for the third quarter has shown there's a little bit of loosening in credit standards across all size buckets. And what I think is notable on this slide is that the bucket that has the most relaxation in their lending standards are for loans under $5 million. And for the most part, that's going to be the types of loans that you'd be looking for in an ETA setting when you're doing an acquisition. But across the board, we're seeing relaxed standards, and I've heard load structures, that's actually loan structures. But I think that's sort of a reflection of a couple things. One, the economy is doing quite fine. Number two is the banks have really strong balance sheets. Unlike the troubles that we had in the past where banks were a little bit handcuffed, now they are really strong balance sheets. They know they need to build their asset base, and they've got some comfort level in what they're seeing in the market, and so they're able to relax those structures more than they had been previously. And when you take a look at, I've got some stuff here on SBA loans, because for the most part, I'm seeing a lot of 7A loans financing lower middle market transactions. And you can see that in the last 4 years that there's been a continued increase in approved, these are just approved loans, not closed loans. I don't have ones that actually did successfully close. There's been an increase both nationwide and in Ohio, although there's been a bit of a drop off in Ohio in 2025. I don't know why that is the case, but nonetheless, it's still a very valuable tool in funding these types of transactions. Interestingly, the average loan size, the SBA 7A can go up to $5 million. The average loan size is under $500,000. I just thought that was kind of a unique statistic. But nonetheless, the volume continues to increase. Ohio is lagging for some reason, and I hope that's not any sign of anything specific to what's going on. There are some new standards that the SBA has come out with this year. Some of them relate to what the bank can and can't do. They can't sort of take a flyer, and so the smaller loans, there are more strict standards that they have to adhere to before they can approve a loan, this do what you do rule. The reinstatement of fees, there was a waiver of fees during the pandemic that are now back. Really, the SBA is trying to be a profit center again, one of the few areas of the U.S. government that claims to make money, although they're closed right now, so I don't know what's going on. Nonetheless, you can see your fees are generally in that 2 to 3.75% range. Not surprisingly, there are tighter ownership rules as it relates to citizenship. They have to be 100% owned by U.S. citizens or lawful permanent residents. Stricter credit scoring, again, I said that the smaller loans, they're taking a little bit more of a rote approach to it. And here they're using business credit scores, raise the minimum requirement a little bit. Taking a look through to the buyers, just look at their personal balance sheets to see what kind of strength they have personally. There is I found this interesting, it's a minimum 10% cash injection. I always thought it was 10% for some reason. I didn't know that was new, but 10% cash equity injection on the deal, and increased collateral requirements. I think one of the things here that I think is really going to be a problem, if this is true, I didn't fact check this little comment here, but seller financing restrictions. So The seller financing says here it has to be on full standby for the life of the SBA loan. The SBA loan is generally 10 years in duration. I'm not aware of any seller that's willing to take a full standby. Full standby means no payment of interest or principal for 10 years. That's highly unattractive from a seller's perspective. So you have to really come up with creative structures that can get around that or try to mitigate that. I'm not sure what those may be because I've not come across that this year. And then the last thing I'll mention is that in these partial buyouts, those sellers who retain an interest have to personally guarantee, which nobody likes personally guaranteeing a loan, but it is sort of a necessary evil for most of your lower middle market transactions. Mark, I believe this is finally you can talk.
Oh,
You want this thing?
absolutely.
All right.
Thank you. And by the way, all these slides are available after the conference, so all this stuff's going to be available. So a lot of detailed information here, a lot of facts and figures. Lloyd's going to have even more. So this will be available for you. So hopefully you paid attention a little bit about some of this information that Lloyd presented when we talk about diligence. And there's some things that will really kind of stand out to you here, but looks like interesting. Looks like all my stuff is no longer like section by section. You get to see the whole thing now. Okay.
No flying.
No flying anymore. Okay, so that's a dodge for you. Must be a PDF. So anyways, due diligence process, who needs it? And obviously the answer is you need it. Your bank is going to require you to have a lot of answers to what's happening within this business. Your investors, obviously. If you are dealing with business insurance folks, or you need a rep and warranty insurance, you definitely have stricter requirements for your diligence process. Goals, obviously, we're here to mitigate risk, understand the value of what's happening, and also think about setting your strategy. So this is kind of your time. If you look at the chart above, you've got your letter of intent signed, you're now in the diligence process. It's really your chance to kind of understand how are you going to run this business? What strategies are you going to operate in? How is this going to work? And the last bullet point about getting it done and not blowing up the deal is it's not about the deal blowing up because of diligence and something you found. It's how you conduct the diligence process that can blow up the deal. So think about it. You're involved with a seller who's very emotionally attached to this business. You're going through a process with them that they've never gone through before. So think about how you're doing this and how you're actually going through this process. So yeah, things can get blown up because you find something. That's okay. If you conduct yourself in a way that's not becoming of the seller, you could blow it up that way. I think the other point here too is think about this a bit from a legal perspective. This is the representation of the business too. So I know a lot of you probably say, hey, Mark, send me that due diligence checklist. And we're like, here you go. Here's your Excel document. Ask Nick for one. He'll send you out one too. You're really paying attention to what's happening because this is where the company is saying, yeah, I don't have any problems with employees. Our building's great, blah, blah, blah. Customers are fantastic. Your diligence process is really important to you also from a legal perspective because if you have claims to the business, this is where you're going to discover things. Oh, wrong way. So all the answers again on the slide. So obviously, if you're looking about a business from a stock or asset purchase, those are differences, and those are going to drive diligence and the diligence process. The things that are kind of the areas of diligence, you can read them, but we'll talk more about quality of earnings. Tax compliance becomes a thing, especially with stock deals. So if you're going to inherit the liabilities of the company, you probably want to have someone really understand what the tax liabilities of the businesses are. If they have out-of-state employees, how have those employees been paid? Kind of what are the liabilities around the tax piece? If you have some IP of the business that you're buying, think about what patents are there, what trademarks are happening. Are those really good, qualified, or do they exist? Are there issues with the patents as well? Ops and IT certainly want to understand, hey, do we have good plumbing of the business? Is it working the way it should be working? Next one, sales and pricing. Here's a very interesting one. I got Mike in the room here, an expert in pricing. Real key thing here too is what's happening from the margins of the business. How is pricing being handled? When's the last price increase that they've had? Is there more you can gain from the business because of pricing power? Really important piece of your analysis. Employee benefits. Often you want to match the benefits of the current employees. So what are you signing up for? What's the plan that you're going to sign up for when you've bought this business? How expensive are those employees, or are they underpaid as well? So benefits is a risk. Business insurance, there's folks who will do a quality of risk analysis for you as well. So insurance firms are out there helping you from a business risk perspective. Business valuation can be part of that, really that understanding of, does this business really have the value that you think it has? Equipment appraisals. Another key one for me is if you're buying a manufacturing business or some sort of a asset-heavy business, this is a really important thing for you to go get an appraisal done. And this can actually be someone coming out on site, seeing the equipment, documenting what's happening, coming up with a fair market value of that equipment. It won't cost you very much money, but it could be a significant part of your valuation of the business. And it's also perhaps when you go to write off that equipment the first year of that business, this can become a really nice tax break for you. So getting that value of the equipment up is going to be very important for financing. It's going to be very important for your depreciation. Real estate, environmental. So if you're buying a property, you're going to definitely need to have a phase 1 study done. No one's going to want to loan you money with understanding the condition of the property. That may lead to phase 2s, that may lead to mitigation, other things. Organization and culture. So another key thing for you to think about and spending time with these companies is kind of, what's the business like today? How are the employees treated? How does the owner today treat these employees? Does the owner need to stay in the business and be kind of a partner with you? And do they have your values? So don't underestimate that as part of the process. I personally was involved in a situation where we walked away from something because we had an owner tell us his employees were garbage. And we said, "Oh, garbage, that doesn't sound very good." So yeah, I pay them, I don't pay them very much. They all suck, and I don't really like these employees. And I'm thinking, well, but we need you to stay around here because you're like the chemist and know what's happening, and you're going to be here in this business, and we're going to run this thing with you. So we walked away. LOI, see you later, blow it up. We're out the door. So it's a real consideration for things. It could be an area for improvement for you too. Hey, I think I can do a better job culturally than what's happening today. So quality of earnings. People ask us, hey, I need a Q of E, and how much is it going to cost?
How much you got?
Right answer. It really depends. So I think the real question is, why do you need a quality of earnings? Are there things that are driving this requirement for you? Are there lenders who want it? Is there a rep and warranty insurance piece? Rep and warranty insurance for our market, for mid-market, probably not a thing. You're not going to get someone to necessarily even give you a rep and warranty insurance package. For larger deals, it's definitely become a thing. We can talk more about that. But in terms of performing this diligence, obviously period and scope is important, right? So someone says, I need a Q of E. Say, well, how many years do you want to go back in time, and how forward in time do you want to go? So what's the scope of this quality of earning from a time perspective? Obviously, the business size and complexity is going to also have an impact on the work that we'll do for quality of earnings, where are we located, multinational, et cetera. And I would say transaction complexity in terms of carve out. So if you are carving out a business from some other entity, it's really hard to understand what's happening today with those financials. So this one kind of really adds scope. Standalone business, straightforward, financials are all here. Carve out of a business that the seller is presenting you with, hey, here's the financials of this carve out. Well, you never had those financials before. How in the world do you say that's the profitability of this carve out? So important piece. Output desired. So do you want a fancy presentation with lots of PowerPoints and pictures? Or do you want a data book that has all the information you need? So another bit of the kind of complexity of quality of earnings. Buyer and seller QV. So sometimes a seller will actually have their own quality of earnings document. And so maybe you're hiring an advisor to help you kind of uncover, debunk, qualify what the sellers put together. So it could be really kind of both equations. Obviously, if you already have a seller's quality of earnings, maybe it's a little less effort to go through and look at what they've done versus what you would do. So next slide. So what are the kind of the outputs of a quality of earnings document? What would we typically see? So the analysis of the seller's adjustments. So typically when they come up with their EBITDA figures, they're going to have a bunch of adjustments. And this is really for us to say, how did they come up with those calculations? Where are the add backs to the business? What's actually happening here? This is a big part of the value add of quality of earnings, is to say what's really happening with these adjustments. What can we prove? How do these things work? I think the other side, since this is your document, you're paying for the quality of earnings, right? This is yours. You're not sharing this with the sellers. This is your document. This is your work. Hopefully your advisors can provide some fresh thinking too in terms of the strategy. So where can we see other synergies in the business? This is your adjustments, the things that you are going to see this business be more profitable when it's under your ownership. Other things that reflect quality. So revenue recognition. Is this business one that just has random orders that come in on some infrequent basis? Is there really recurring or reoccurring revenue? Differences there. So how frequent is this business? Are they a model that we're getting paid every month, whether there's product shipping out the door or not? That's going to impact the quality of earnings. Customer and industry concentration. I don't know if we've talked much about that at the ETA conference. I haven't heard too much people talk about that, but obviously if you buy a business that has one customer, that's less valuable than a company with lots of customers. So you want to have a diverse customer portfolio that lowers your risk. If you lose that one customer, you're out of luck. So obviously this is important, and we typically want to break it down both by customers and industry. So if you're all tied to one thing, as this one industry goes up and down, the quality of that revenue is going to be impacted by industry fluctuations. So if you can have a diverse customer base with a diverse industry concentration, that's really golden. And I think one of the things that's key about this too is if you get a list of customers and they say, here's 50 customers, you need to dig in and understand, are those 50 customers related? So sometimes it's, hey, they all have different ship tos, but the reality is there's actually maybe some consolidation there. We typically do a proof of cash, so we'll tie back the bank receipts to the reported revenue. This is actually going through bank statements and understanding, did the cash actually happen? Did we actually get paid by customers? What's the seasonality impact and kind of normalization of expenses? Part of your Q of E and the value add of kind of financial due diligence is also setting your working capital, right? So typically, when you're buying a business, you're going to have an adjustment for what's called net working capital, right? And you're going to want to know what those numbers are. And that's another value add of this process, is to say, what's happening with receivables? Do we have a bunch of old receivables out there? Is the inventory slow moving? How do we pay our suppliers? And then if there actually is a CapEx budget with your company, so a lot of companies, you say, hey, what's your CapEx budget? And they say, well, we don't have one. And then you say, well, what equipment do you need to run your business? And they say, we have it all. And you say, well, this thing's pretty old. That thing, we did our appraisal and it came back with a bunch of garbage. So really looking at historically how the business has spent money on equipment and what that's going to mean going forward, it's going to be important too. KPIs, if there's key business drivers like delivery, we kind of want to know that. So, hey, this business is underperforming in the delivery model, or it's performing well. We need to understand kind of what those key metrics are. Employee turnover is under a key one to look at. Those are all key performance indicators to take a look at. So why would you have internal resources versus external resources? This is the self-serving portion of the presentation. So transaction advisors, lenders are going to require typically third parties. So if you say, hey, someone came in and said, I really need to see a quality of earnings report, you can't probably do it on your own and say, well, here you go. They're going to say, we need someone to actually do that for you. Buyers don't have the expertise. I mean, these are a lot of different things going on. I'm not an environmental studies person. I can't go do record researches on properties. I'm not going to go do boring samples. So there's really a practical need for transaction advisors. You are very busy in your diligence process. You've got a lot going on. So there's a time element too. So can you leverage the work? Can you have other people help you with this process? And then the other piece too here is advisors become your long-term partners. So you're going to get a lot of free advice along the way. If you start reaching out to folks and say, hey, I want help with this, I want help with that, the tendency is to want to help you be successful. So your advisors are going to want to help you be successful. They're going to give you tons of advice along the way. Please feel free to use that. Okay. All my answers at the end here. That sucks. Okay, anyways. So diligence is a parallel process. And think about this too. You're typically also doing your purchase agreement while you're doing your diligence. So there's a lot going on during this diligence period. You've got a ton of things happening. You're running diligence, you're getting your purchase agreement in place, you have to deal with leases, you're maybe putting a staff in place, you're getting your bank account set up. And other things that I would say would be very important if I asked you this question, I would also suggest, is your health. So keep in mind, you're individuals, you're human beings. Buying a business, selling a business, probably that and ERP implementations, that's when people die. I mean, literally, people have heart attacks. It's very stressful for companies going through this event. And so keep your health, in check. You're also developing relationships with these sellers. And this last bullet point is really your deal flow pipeline. And what does that mean? Anybody got an idea in the room? These are supposed to be Q&A, but go in the back.
You got to keep your deal flow going while you're going through the acquisition, and you might fall through.
Why is that Mitch back there?
It is.
Why do we have to keep our deal flow going?
Well, in case you have one of those 4 LOIs that didn't go through.
Key point here. Yeah, so this is the other trick of the trade. You've got to keep it going. You got to keep it going until the very end. And there's going to be tons of stories in the room where you said, hey, the first 2 failed. I kept the other one going. And we got it done because we basically kept these things happening. So keep your deal flow going. You're not done yet. The money hasn't transferred to the seller. You don't have your APA signed. The deal's not done until it's done. Any questions on this section? Because the other section's the data part. Comments on diligence? More? Should I pick names to make you answer a question? Yeah. Kyle, Franz, tell us.
We got this question here.
Kyle, what's your question? Sorry.
You're asking if I have a question?
Yes, sir.
Um,
I'm just putting you on the spot.
Yeah, so for third-party due diligence, how is AI impacting that as far as time and pricing, right? I saw that you had, 30 to 60 days, right? If I have a reliable financial model, a bunch of reliable, bank statements, all the documents provided in a Dropbox already, in the seller's thing. I mean, how much of that has become drag and drop and the models can be kicked out and automated? And what level of that is remaining? You need human eyes on it that'll catch some of the more nuanced pieces that, aren't going to be captured if you automate it on it.
That's a great question. Obviously, it's helping the process time become more efficient. I think it's actually helping the quality of the work too, because, in the past, you kind of got a bunch of PDFs of financial statements. You kind of went back through them and figured things out. Now this has really gotten to be much more of a data-driven transaction level, rebuilding the financial statements. So it's gotten really, I would say, not just faster, but the quality of analysis has gotten a whole lot better because it's really at a much more detailed basis now. So those types of tools are making this a better process and really providing greater levels of diligence that we've never had before. Great question. Glad I forced it out of you there, Kyle. Yeah. Anyone else? Before I pick names. Oh, sir.
Yeah, what kind of frictions arise between the buyer and the seller? Just speaking to due diligence, and how you can avoid that or that you
Tons of frictions. So this has been having an intermediary. I think we talked a little bit about this before. Someone was mentioning in another session, having that intermediary between you and the seller is very important. So that can aid some of the friction, but you're really in an unknown, uncharted world when dealing with folks who are emotional, who change their mind on things, who don't have all the answers. So kind of anything can happen. You get your new insurance set up, and all of a sudden that insurance information goes to the seller's home address versus your address, and now they're freaking out about why that's happening. There's a lot of things that can happen during this process of transition that are really hard to control. So having a relationship with these folks is important. Having a relationship with the person who's selling the business is really important too, because they want you to win. Like the brokers want. They want to close the business. Nick wants to get the deal done. He wants to move on to the next one, right? So, having that confidence with the intermediaries is really important, that they're bought into seeing they want to see you be successful. They can be your advocate to kind of help with those communication issues, smoothing out when we'll make mistakes along the way and how they help. Kurt?
So Mark, on the slide, you've got, it's a parallel process. There's a lot of things going on at the same time during due diligence. Can you speak to maybe just how to think through all those activities in a way that enables you to get to that finish line to close the transaction, but also to do so smartly to de-risk? There might be things that you discover that are walk-away criteria, but you're also potentially spending a lot of money along the way, going through due diligence.
I think, first of all, have a project timeline and a plan, and being very transparent with that plan with everyone. So, you really can meet on a weekly basis with the seller, their advisor. You're talking about what's happening from a process perspective. So I know you're a process guy. So, really having that project plan and explaining what's going on, what are the steps of this process, being very transparent to everyone is really important. I personally think you're going to take a risk and start paying your attorney sooner than later. So there's a cost to diligence. If you're going to say, I'm waiting for everything to get done, and then I'm going to start work the purchase agreement, you really are going to lose a lot of time. You've got to work in parallel. A lot of folks say, oh, I got it, done with diligence, now let's get the purchase agreement put together. I think you've really got to work in parallel. You've got to get this done. Time is your enemy, right, in terms of a deal. So I truly believe it's a parallel process. Yes, sir.
I know every acquisition is going to be different because there's different factors coming in. But do you have a rough number of what you would typically allocate for the third party external evaluation? There's always a plus and minus, right? What would be a routine?
In terms of like time or money? I mean, really, I think back to my slide on complexity of the transaction. Can you have a small business deal with a $25,000 quality of earnings? Sure, you can have a relatively inexpensive Q of E done. Can you spend $500,000 on a very complex deal? Yeah, sure, you could pay a very large firm to do that kind of work because it's a complex deal. So it really varies based on what's happening. But it's not a $500 project.
I was thinking more like 5% or 7%.
Oh, in terms of, you got an idea on that one? Yeah, I've never really been able to tie it back to the.
No, I think most of the transactions we're involved with, you're looking at least $100,000 out of pocket between legal fees, accounting fees, insurance, bank fees. You can finance sometimes, depending on the product you're using, but not cheap.
In a lot of ways, too, kind of those expenses are going to be somewhat, I said it's based on complexity, but there's always going to be some base costs, right? So whether you're buying a $5 million business or a $1 million business, legal fees can be actually fairly, you've got to get through the work. It's going to cost about the same. So there's always going to be kind of almost a fixed cost if you think about it that way. and then add on the complexity of what might need to get done. But there's definitely fixed cost in that. Mitch.
How much of that are you able to roll over into the purchase price, or like the part payment till after the acquisition?
So I don't think it's really part of the purchase price, but it's really part of the value of the business and expense of the business. So yeah, 100% you should want to make that part of the cost of the business. So it shouldn't be Mitch spending money on attorney's fees. It's the new entity paying for those things. And a lot of folks will pretty much wait till the deal's done, and that's when everyone gets paid. So typically everyone's in a waiting game to get this closed, and then everyone gets paid at closing. So we all get our checks at the time of close, and that's really part of your new entity. So that's something you've built into your cost structure. It's a write-off, not a great write-off, but business expense. I got one behind you right here.
Is due diligence different if you're doing like a partial buyout in comparison with like a complete acquisition?
Maybe explain partial buyout versus complete.
I saw it on the PowerPoint. It mentioned like partial buyout, so it's like you're not buying out the entire company, you might be kidding.
Oh, like a carve out.
Yeah.
I think he's talking about you're not buying 100% of the equity, you're buying the majority of the equity.
From an equity perspective, or from a product line, or from an equity perspective, like you're buying part stock purchase, you're buying part of the stock deal.
Essentially.
Well, I think you're still going to have a fulsome diligence process. I don't think you can. It's your level of risk and how you're financing it that's going to drive some of that. But from my perspective, it should be full diligence. And then in the front, closer. No, you sir. Yep.
Trying to think. So ultimately, with all these expenses that you pay for due diligence, if the deal doesn't go through, you move on to something else. Would those be then write-offable towards a future deal that does close as ultimately business expenses?
I'd have to talk to my tax partners on that one. That's interesting. So typically, if you had like an LLC set up to buy a business, that LLC may have a lot of expenses and a write-off. I guess if you had a corporation, maybe you could roll that forward, but yeah. Yes.
That is a lot of expense. But I do want to discuss, I think this is a good question for us for asking about the cost. I think it's good to talk about that because, sorry, Director, but it's good to talk about that to give people realistic expectations, just like when you're a home buyer, like what are you looking to pay for, so that you come to the table kind of fully expecting that. So thank you for that. But I think I was going to clarify, I guess, what would people expect from a financial diligence or versus legal? Because those are usually the standard diligence that's going to go on for legal, right? Legal diligence, financial diligence, based off the size of the company, maybe $1 to $2 million.
I'm not exactly hearing the question.
Oh, I'm sorry. Can you hear me?
That's better, thanks.
Thank you. Well, I was saying, I was saying, what's a realistic breakdown to expect on maybe like average or something of that sort? I know you can't commit to a number for financial versus legal, which are usually
Lawyers always cost more money than accountants.
Usually, the more typical one that somebody would have to get for every single deal. You said lawyers cost more. You said I think you threw out like maybe $100,000 for most deals.
Yeah, I'll just take a flyer on this one. I think from an accounting perspective, you can expect, again, going to vary a lot, but I'll throw out 15 to 25,000. Okay. Your legal's probably going to be 75 to 125. It depends on the complexity. Legal diligence is all part of the drafting of the purchase agreement as well, so it's not like a separate process from the diligence and the purchase agreement. It's all one big exercise. And it depends, again, you might have a law firm that needs 4 different attorneys because you've got real estate involved, you've got patents involved. That could make it a lot more expensive than something that doesn't have those characteristics.
I mean, I personally know people who've bought, a $2 million revenue business and spent $75,000 on legal fees, and someone who spent $10,000 on legal fees. It just really depends on the deal, how sophisticated, the seller is, and what complications you run into for the business. So it's really hard to put a number behind that. Also depends on how many times you've done it, quite frankly, too. I mean, there's folks in the room who probably, if they've done multiple transactions, they know what to anticipate. You're the DIY person and you're going to help move things along a lot. Someone who doesn't have that experience is going to typically pay more because they don't have that background. Yes.
I know how I would respond, but I want to get your take. So obviously with the LOI percentage being, call it 20%, getting to closing, when you have somebody who's under LOI and they're coming to you and they want you to review the financials, and people have very expertise when it comes to looking at a tax return, P&L, a balance sheet. Some people can barely spell those things. Doesn't mean that they won't be a great fit for the business. What do you say when they're like, well, I don't want to sink a bunch of money into this LOI in the event that it doesn't go through and I don't get the business?
How would I advise them that that would be a bad thing to do? I mean, you've got to get you've got to go through a process one way or the other. You should plan on this. You need to think about your financing in advance of the deal. So when you're asking your friends and family for money, you've got to put aside $25,000 to $50,000 to think about getting this thing done, because you've got to make it happen. So I would say sorry, and I get a better answer than that one. I don't really know how to advise someone to say you really shouldn't go through a fulsome diligence. If you think you can do it on your own, and then good wishes. I hope it goes great for you. But I can't imagine some of the things that over time that we've really had a lot of value with having other folks take a look at things. Are we out of time?
Yeah.
Oh, great.
We're hitting 40, so we gotta.
Great questions and questions.
Sorry we didn't get to the multiples. Happy to. The photo op. All right, right there.
Which one?
It doesn't matter. There's your photo op for you. Get your cameras out if you're interested in purchase price multiples. Here's your trend over time for companies based on different values. You can see that for the most part, there's not a lot of change year to year. Just put one more. This is my caution. No, one more after that. I always caution people, don't go by averages that you see in different reports. I've got two different reports here. I've got the Pepperdine Cost of Capital study, and I've got the Deal Stats database. You can see averages for different industry sectors. For the most part, you can see some similarities between the two databases. But what I want you to take away from that is the far right column are actual transactions we were involved with. You see the purchase price multiples were considerably different than the averages. So don't rely your purchase price value on the averages that you see from one of the databases. Or if you ask me, what's the purchase price multiple for construction? I can tell you what the average is. I can tell you that whatever you're looking at is not worth that average. It's going to be higher, it's going to be lower. I'm happy to tell you why at a later time, because we're out of time.
This information is going to be out there available for the conference. Contact Lloyd or myself if you want the information sooner. We're happy to provide the whole presentation to you and answer any questions. Thanks again for everyone's time. Thanks.